actually be curious to hear you guys all discuss this concept of looking for less units but deeper affordability in, for example, a seven cottage setup like you have at Rye Meadow or something else. How would that work together for you versus having to have a higher percentage of affordable at not as deep a rate? Does that make sense?
To do inclusionary zoning affordability at 7 units?
No.
If you didn't in that one, can you talk about how a model like that might work for the two of you?
Yeah, it would definitely work, but there would have to be a partnership with someone like CHT, because for us to get into perpetual affordability on our own, it's hard. Selling those units just on the open market is a challenge. So unless you have that partnership, I think it's really hard to make work.
I think I should let Amy say it for herself, but I think the point that Amy is making is that by putting by providing a lower income threshold, or that we wouldn't need to use additional public subsidies to make that inclusionary unit available to a low income household. So what's happening now is there's an inclusionary zoning unit, but on its own, it's not really available to a low income person, because it's still a challenge for that person to afford. And so it's more about the lack of resources to make that unit, or lack of public resources to make that unit affordable. That's what's driving your comment, I think. Is that right?
I think typically towns are requiring 10% be inclusionary requirement often. What I was suggesting is that if it were 5%, but the targeting was much deeper, then we wouldn't need to bring that additional subsidy. So then we could do that without that additional resource. It would be a standalone new affordable unit. Does that make sense?
One of the challenges too is that when you have mixed product within a neighborhood, you don't want them to look different. Okay, and that's critical, because you don't want someone that's buying that affordable unit to feel like an outcast in the neighborhood. So you have to kind of bridge that visual gap and quality gap too, and that's can be hard at times, but I think it's possible.
I think that really is the major benefit of inclusionary zoning requirements, is that you are interspersing incomes throughout a neighborhood. And actually even the benefit of our shared equity program generally is that you can't pick out what are the affordable units, because they all look the same. They're just integrated into the neighborhood.
So I think part of it too is, scale helps a lot, right? So in a 7-unit project, it's really hard for anybody with nonprofit help or not. It's really hard to make 5% or 10% of that project affordable, because at 7 units, that means whatever percentage it is, 1 out of 7 has to be affordable, and it's really hard to carry the water on that. So part of it is setting the threshold for, you don't even, inclusionary doesn't even apply unless you reach a certain scale. And then the deeper levels of affordability, it's all math, right? So, I don't think developers like Brad and I care whether it's 10% at 65% or 5% at 50%. If we can make the math work, we're okay with it. It's really just finding that right balance and that right level.
So I have a question for Brad and anybody else up there. So, hey, Brad, this is Tim Barrett. I used to be on the DRB, just
Hi, Tim.
City Council South Brazilian. So if you had your druthers with the Rye Meadows development, would you prefer to have built more cottage-style homes? Is that a higher profit margin for you, building more homes that are smaller, yet they're separate from each other, And if so, would you consider in the future using pre-manufacturing facilities for modular assembly to get your costs down? Is that something that's coming up in the future?
The cottage units at Rye were a bit of a loss leader for us. So I don't think I could really do a whole neighborhood of them, even with scale. But per Eric's point, we made the numbers work. We knew that we were going to build and sell these 7 houses. When you look at our total carrying costs and everything, pretty much at a loss. But we were selling single-family market rate housing, and we also had a commercial component of Rye too. So I think the more components you can mix in these neighborhoods, the numbers make more sense. Looking at modular, we're always evaluating lower construction costs. What I'll tell you is that being an Act 250 developer, if I was to build a house tomorrow and you were to build a house tomorrow, the house that I would have to build is a much higher threshold with energy rating. So it gets harder and harder to make certain construction techniques work. It only gets more expensive. So we're always looking at new ways to build houses for a less cost.
It seems like part of the problem for a developer in terms of making a project work is that appraisal that comes from a new unit, and knowing that that's what it's going to be worth in the future. So is the problem with affordability this appraisal that we're banking on, or is it more just, can you speak to that a little bit?
It's not really an appraisal problem, right? There's a tremendous amount of risk involved in this process, right? So when any developer goes into this on the front end, knowing, like Nancy was showing at the beginning, that you're going to have hundreds of thousands of dollars at risk before you even know whether you have a project or not. To take on that level of risk, you've got to know that you're going to get a decent return on the other end. And for the nonprofits, they have to believe that in the end they're going to be able to pull the project off and get the development fee out of the front end of the deal and pay themselves back all the money that they've expended into that process. For the private developers, my development fee is actually much smaller than what the nonprofits experience. But then I've got cash flow going forward. I've got the expectation that over time there's going to be some appreciation, and I'm going to earn some money back on that. But if you think about the numbers that I was showing, and showing that typical, my last slide showing that typical Burlington project, and at the end of the day, there's a return of 4.7% or something like that. Why would anyone take the kind of risk that we take, only expecting that in a good day, that's the return I'm going to get, and on a bad day, my return is nothing. It's less than nothing. Why would anyone do that when I could invest in municipal bonds and get 3%? Or why would anyone do that? So that's really the issue. And when I have to borrow money at 5% or 6% or more, when I have to borrow money at a rate that's greater than the return that I expect to get, I'm upside down on my leverage. So that's the problem we face. It's not we just need appraisers to give us a higher value. That wouldn't help us at all. It's the return on that project would still be a problem.
It seems like the costs for new housing is so high, and that the selling price is so much higher than median income. Should the affordability effort be targeting existing housing stock that's maybe already at a lower rate than this new housing? And what ideas do you have for how to make that happen? How do we get more homes that are already built in the Champlain Housing Trust program, for instance?
Well, we do that. We have this buyer-driven project program where we provide subsidy to folks to buy a house that's for sale on the market. The other thing we've done recently, we've done this, I think it's 4 times now, we've purchased existing rental housing, and then we've converted them into condominiums. So, for example, we did this in South Meadow in Burlington. There were duplex units. There were 16 buildings, so 32 units. They were rental apartments, duplexes with attached garages. We converted those, we did some renovation on them, and then we sold them as affordable homes for sale, as condominiums for sale. So that did increase the supply of affordable home ownership. It also, though, it didn't, it reduced the rental housing on a flip side of that. But we've done that a number of times now in a number of different communities.
I've heard repeatedly from the developer community that reduction of parking requirements could make it more affordable to build affordable housing. Can you speak a little bit to that, and how much would that be, and what would be the impact?
Yeah, I think the key with parking is giving the developer flexibility, right? So I know all these developers at the table, we know what we need to provide for parking. We know what our renter or our buyer is going to demand. So if we're confident and willing to take the kind of crazy risks that we're willing to take to build it, then give us flexibility on how much parking we have to provide, and have faith that we'll figure out how to deliver that right balance to the market. I'm not going to build something with zero parking because I can't rent it. I can't sell it. And depending on what kind of product it is, I mean, we've been very comfortable with parking ratios at about 1 space per apartment. Sometimes 1 space per bedroom makes more sense to us, depending on the location and the type of household that we're likely to rent to. There are projects where less than 1 space per apartment or home can make sense because it's downtown, it's transit rich, it's, it really depends. It killed me that on that Pearl Street project across from the liquor store in Burlington, we had a parking requirement of 2 spaces per apartment. We were building studios, 1-bedrooms, nothing bigger than a 2-bedroom. Thankfully, there was a waiver process that we could go through. But even a waiver process, waivers are scary for developers because waivers are discretionary. And when a neighbor doesn't like it, that is something they can sink their teeth into on an appeal. And so we would much rather just have the rules be more flexible than have the potential to get a waiver.
I've heard, this is more on the density regulations and how they play out in the process, that some people think we should have density minimums instead of maximums because they're discretionary, and the maximums are discretionary, and you got a lot of neighbor input, and you can't count on, that's that lack of predictability again. You can't count on the number of units that would make the project work financially. So just some responses to that. Or
I think the answer to that is it depends how the bylaw is crafted. Maximum density is only discretionary if the bylaw is crafted to make it discretionary. If it's clearly a maximum and there's no board discretion over that maximum, it's as of right, then yeah, there's some risk that a neighbor might come along and try to argue to a judge or whoever that your project is too big. But if the bylaw clearly allows it, then it's not discretionary. Where it becomes discretionary is when it says that it could be up to this amount, but it has to fit with the character of the neighborhood, and there's bonuses that you might get if everybody likes you, and that's when it becomes discretionary. So I don't know about minimum densities. I haven't thought about that much. I can imagine some people wouldn't like that because then you're sort of telling them that they if they wanted to build something small on a parcel, they wouldn't be allowed to.
I work in finance, and I'm at Morgan Stanley, and I've been in finance for 15 years, and I see the other side of it, where recently we just had a low-income housing bond come, and we could sell it to our clients, and I had you had said, why would I invest in something that's 4.5% when I could invest in a municipal bond? And actually, if you could find a municipal bond that was 4.5%, it'd probably be a 50-year bond. Like, that's a really good rate of return. So when on the client side, when private investors see those rates that you're talking about, they're very attractive. So when we had that bond come and be able to be sold, it sold out very quickly. So can you speak to what the sources of funding are and maybe opportunities that you see to get more private individuals funding these types of things? 'Cause I think there's a huge market for private individuals to be wanting to invest in things that have a social impact, a tax-free yield, a fixed coupon payment, and some dependability, and maybe like some sort of guarantee or insurance from the state or federal level.
Okay, so I'll try to I'll try to speak to that without getting too. So the financing for the affordable housing, we typically use the low-income housing tax credit program, which funds about, and we raise equity for those tax credits or federal credits. The federal government issues credits to every state. The state then issues those credits to developers. The developers sell the credits. It's a one-for-one dollar adjustment of your federal tax liability. We sell the credits, right? They get priced at a cents on the dollar or a return. So right now they're selling around 90 cents, 89 cents. And so the investor gives us that capital, and we put it in the project, and the investor gets the benefits of being a part owner of the project from the tax standpoint, and gets 100% of the tax credit. Those tax credits finance 60 to 70% of the total development costs of the buildings that we're building multifamily housing. The balance of the rest of the money comes primarily from state and federal grants. And we just finance a little bit of the housing through conventional financing with mortgages. So when I say the financing, we have higher financing costs, it's not that our interest rates are higher on the money that we're borrowing, because we're not borrowing very much money compared to a private sector developer. But our financing costs are high because what I just described to you, it takes a lot of deal structuring. It takes and it takes a lot of compliance and reporting. The cost of capital is not high, it's the cost of compliance, the requirements of the investors around the guarantees, the level of operating reserves, so it's not the cost of financing, but it's the deal structure itself that adds costs.
I think the challenge is what Nancy was trying to explain, that for the really deeply affordable housing, this is housing that is affordable to households at or below 60% of area median at the high end, and a lot of it's affordable at 50% of area median or lower. Some of it's 30% of area median or lower. To be affordable at that level, you can't afford any debt. The money you're getting is tax credits and grants, and what makes it expensive is the structuring. Every program that you're being funded by has their own rules and things that you have to do that add cost to the unit that you're building. I think it would be a lot easier for projects that are mixed income with a heavy market rate component or a heavy 80% of area median component. Those kind of projects would be able to take advantage of 3.5% interest, municipal bond type financing. But and then there is some social impact. I think of like the Vermont Community Loan Fund that we've worked with and takes a lot of risks on nonprofit projects as well. Where they end up coming in is in a very risky position, like on top of all these other sources that are ahead of them. So their money isn't cheap. It's 5.5%, 6% money, but it's commensurate with the risk that they're taking. So,
just curious if what you as developers think of density bonuses in a set of zoning regulations that you get 25% more units if 25% of them are affordable, for instance.
I haven't seen a density bonus crafted in a way that creates the incentive that is needed to make a developer take advantage of it. And sometimes the density bonuses aren't really bonuses. They're You know, the words might say bonus, but what the substance really says is you have to do this. You know, so.
I mean, and I work all around the state, and you know, I see we often are not getting. You know, if we could just build to what's allowed, we'd have built more, right? Whether that's, I mean, sometimes you can't build enough because there's other restrictions, right? There's lot line adjustments and parking, and there's wetlands or stormwater. Or there's, you know, the land can't hold that capacity. But there's many times when the land can hold the capacity of the maximum development, but we're still not able to build to that amount. Whether it's, you know, compatibility with the neighborhood, politics, the amount of financing we can, for us, sometimes it's financing limitations. And so a bonus doesn't drive that incentive that much if you're not even reaching, you know, the maximum allowed. So I think there maybe could be a different way of crafting that.
There's often also a disconnect between density, height, lot coverage, parking requirements. So, you know, that theoretical maximum density, without a bonus, you never get there because I can only build 3 stories and I can only do 50% lot coverage. And so a lot of times there should be like a hypothetical project for, you know, every zoning district created to see, you know, okay, we came up with this. Does this really work? And I don't think that happens. Yeah. And don't do it on a perfect lot either. You know, do it on a weird shaped lot, because this is New England and, you know, everything's weird shaped.
So it sounds like for bonuses, if we could cut costs, that would be the thing that would serve as a bonus. So reducing parking requirements, reducing impact fees, things that are a direct financial benefit to you is the fastest way to get more affordable built. Is that correct? Thank you.
All right, anybody else?
I think the other thing, you know, there have been some towns and municipalities that have taken some risk to master plan areas of town and get all the Act 250 approvals in place for an entire district. You know, and I'm not talking about growth centers and neighborhood development and all that. Those are all great. But I'm talking about having Act 250 covered. That's huge for a developer.
I'll take an opportunity to say 2 things that I guess were left on my notes back in my office. I don't think I made the connection really between affirmatively furthering fair housing and building affordable housing in good places. The connection, you probably already guessed, is that a lot of people in protected fair housing classes tend to be lower income than the general population. So if the opportunity to rent housing, and particularly affordable housing, is less available, then they are disparately impacted. So that's considered really a form of not affirmatively furthering fair housing. Let's put it that way.